Let's talk a little bit about housing, because we kind of keep coming back to that one. For our audience, so that they can kind of understand, walk us through right now, when we think about your current mortgage payment, how much is your current mortgage payment, and then how much rent do you have coming in, and then how much you're having to pay for rent in the place that you're renting now. So we can kind of have those numbers to level set.
Those numbers are all pretty even. Our mortgage with the interest and taxes is about $2,300. The rent we're bringing in is $2,150.
Okay.
And the rent we're paying is $2,200.
Awesome.
So yeah, they're all kind of in the same ballpark.
Right around there.
So we are very close, it sounds like, on the Pennsylvania home to being cash flow neutral, right? It's a little now, for these friends that are in there, now if they're listening, I'm sorry friends, but I'm going to ask the question. Are they paying at market rent, or is this a sweetheart deal? How's that deal structured?
It's at market.
At market, great. Okay. So whenever I think about someone who has an out-of-state property, and it's an out-of-state property that they're not necessarily doing as an investment per se, but they want it to be this thing that's sort of a contingency plan. If I'm describing that right. One of the things that we would love to see is, okay, is there a way to make it cash flow neutral so that it kind of is compartmentalized and sitting over here by itself rather than pulling from present day consumption? Because right now, when I think about your housing, you're paying $2,200 in rent plus an outflow to cover the shortfall that the Pennsylvania house is generating. Would you agree with that assessment?
Yes.
Yeah.
Y'all are reserving, was it $400? How much a month are you putting into repairs?
Yeah, it's at least $300, $350 maybe into that sinking fund.
How many months have you had $350, $400 worth of repairs on the?
None.
No.
Just
Not zero, right? You had one single event.
And that's why I think it is recency bias. Because I mean, houses are great, but they're also scary. Outside of your heating and air system, the sewer, and then your roof, that's really your core systems. Y'all have covered the sewer, it sounds like. How old is the HVAC system on the house?
It doesn't have AC, but the heating system is on the older side. We know we're going to have to replace the boiler probably sometime in the next 3
And what does
to
that
5
cost?
years.
Do you know?
Not really. No.
Okay.
Yeah, several thousand is the number I have in my head, but that's rough.
That's a pretty easy thing to figure out.
Yeah.
Some quick AI or Google research, or even just calling a local technician to ask them, hey, what would it cost to replace a boiler? And that way you at least know the number you're shooting for. Because it seems to us, when we looked at, because you were it was so helpful that you sent us your sinking fund breakdown. When it comes to cash management, we like for you to have an emergency fund where you keep 3 to 6 months of living expenses compartmentalized. And then some people like to use a sinking fund because they know they have short to intermediate term goals coming up. Hey, I know I'm going to have to replace the car, or I know I'm going to have this vacation, or I know I'm going to. But it's interesting, when we look at your sinking fund, there are a lot of different buckets here. Kind of walk us through these and how you guys are thinking about this excess cash.
I get the haircut comment now. Yeah, so essentially this was a catch-all for all the expenses that aren't monthly expenses. So that's why something like haircut or clothing ended up its way on there. That's not
Sewing.
Yeah, the sewing money. That's not something we can predictably allocate every month. So
Sure.
it just ends up in a sinking fund where it's like a smaller amount that goes in there every month, and we have it to like spend down. And then there's the bigger categories of a future car down the road, wanting to have money for that. The car maintenance, same thing. Just you get hit with several $100s here and there, but not every month. And then the house maintenance as well. Just thinking to have that for big expenses. The escrow is actually because we pay the taxes and insurance out of our pocket now. Like, it's not part of our mortgage, so that's why that's there. But then, the smaller things are just kind of miscellaneous things sprinkled in there, I guess.
Allowing us to spend freely and
Right,
with
so
liberty.
I imagine this is sort of guilt relief, right? Hey, if we have this, so I don't feel guilty when we spend it. Well, let me ask you a question. If I were to ask you what your monthly burn rate is, based on your current, because budgets are so unique to every person, every couple does it a little bit differently. So when I ask you guys, what's your monthly burn rate? What would your answer to that question be?
73.27.
But who's counting exactly, right? So, okay.
Study up.
So if our monthly burn is about $7,500 a month, and we would say, okay, you're a 2-income household where you both earn about the same, you don't have any other dependents counting on you, you could reasonably argue that 3 months would be an appropriate emergency fund for you guys. In your minds, instead of thinking through all of these different like sinking funds and contingencies for all these different things, what if we just increased the monthly cover to 4 months or 5 months? And we know that what those additional months are going to do are cover some of these other costs. Because what it looks like is happening is you have a bunch of different contingencies that are likely not going to all happen at once. I mean, you've already said right now, you have $8,700 in your rental maintenance budget, and you're adding to that every month.
Waiting for the sewer line to break again.
And you just had that happen, right?
Yeah.
So it seems to me that it might be practical or prudent. Instead of having 3 months of living expenses, you could have 5 months or 6 months of living expenses. Then you know what your true cash exposure is. Because what I worry about with you guys, and we see this with clients all the time, is that we compartmentalize this cash, and what we end up doing is being way, way, way cash heavy. Where instead of having our money actually working for us, doing the things to help us move our financial circumstance along, we're way overly conservative and we're way cash heavy. And I think for a 25-year-old couple at your stage, you probably are a little bit more cash heavy than you have to be.